29 November, Wednesday. All right, guys, this is Kel once again for MAO. Now, the Federal Reserve must cut interest rate or face potential hard landing. This is from Bill Ackman, the one billionaire that has been making lots of money from the market recently. And apparently yourself, right, the where he covered his bonds was perfect as the bond price recovered. So that is a lot of reason why we should listen to him. So without further ado, let's go into the details. All right. Now, first of all, disclaimer apply as usual. Thank you, Ames, for the kind sponsorship. So now the thing is this, many big boys are extremely bullish right now. Bank of America sees S&P 500 rising to 5,000. I covered this recently. And of course, we also know that, right, the RBC also looking at a double-digit gain in the S&P in 2024. And of course, we also know that this Deutsche Bank also came in and said that S&P will be gaining more than 11% and reaching a record level by next year. Okay, the question is this. Bank of America, the RBC Bank, and Deutsche Bank. Now, those banks are those who were in quite a bad shape back then, right? Recently this year. So for them itself to tell us that they're going to have a big rally, then why don't you just buy everything up for their own, and then they will be off the woods, right? So this is something that I want you to think about it for a moment, yeah? So basically itself, right, you can see the market strategies sound bullish for the stocks for 2024. They expect a 19% rally. Wow, okay. They really expect more gains, sorry, my bad. After a 19% rally this year, they expect more gains. And in fact, it's all right. BMO, one of the hedge funds, says that, right, this will see 5,100. Some even actually say 5,500. Oh my goodness. The numbers are really flying to the air. But the question is this. Are we out of the woods here actually? So this is a good question that I want you to ponder for today. So based on the Wall Street expectation right now, you can see that only Morgan Stanley and Barclays is expecting the S&P to be down to 4,500 for 2024, which is quite expected because Morgan Stanley with Mike Wilson there have been pretty bearish. But you can see Goldman Sachs is looking at about 4,700. Social Generally is looking at 4,750, but Bank of America, RBC, Deutsche Bank, BMO, all looking at 5,000 to 5,100. So the question is this, we have very big two different camps. One is the lower, one expect the market to go down, one expect the market to go new high. So what is happening right now? So basically for December as well, right, many people have been asking me what is the usual pattern. And of course, undeniable, the usual pattern for December is positive, okay? So in fact, it's right, November, usually we don't see that, but we have a very strong November period right now. So the question is, will this be a, like a beforehand thing itself, which is happening right now? So what happened in December, or because November is so strong, they're not supposed to be super strong, but yeah, it's so strong right now, the market in December will be even higher. So there's a lot of things that you can consider, but very important thing is that the greed and fear indicator right now, we are doing at about 65, and based on the trend timeline, we can see that usually we're still not at the point of fear at the moment, greed yet, because why? Usually at the peak area itself above 75, then the market will start to come down. So at the moment now, we may see some resistance, but it's still not the point of panicking. So again, because of all these reasons, it seems that the market is still pretty bullish. So the question is, why then Bill Ackman come out with this? So Bill Ackman came out and says that he bets Federal Reserve will cut interest rates as soon as first quarter, which is kind of in line with what we're saying. We do expect that by March, April itself, we should see a rate cut. All right, because the investor sees risk of hard landing if the Federal Reserve doesn't cut. All right, he observed the evidence of a weakening economy. Now, what is this? We have RBC, the Bank of America. All right, we have this Goldman Sachs, we have the other bank, Deutsche Bank. All of them are so optimistic of the market. So why is the billionaire Bill Ackman seeing the opposite side of that? That is something to think about. And because of that, so let's take a look right now. This is the CME Fed Watch 2. You can see currently now the interest rate is at 5.25 to 5.5, right? Okay. And you can see that we have no chance of a rate hike in December, all right? But apparently, right, there's an interesting shift right now. There's about 10% shift that there could be a rate hike in January. That's interesting because this number was kind of flat the last time I saw this, right? So the question is that going to be one more rate hike in the January period. So the thing is this right now, you can see very clearly the market is actually looking at by this May itself, which is like, after April, that there could be a rate cut. Okay, it's up to 44.4%. So the question is, 2 weeks ago, Jerome Powell says that there could be a rate hike. All right, if appropriate. So what is which? But again, if you look at the inflation numbers in the month of October, where it came out in the November period, the CPI data really came down a little bit. So the question is, if the CPI data goes back up again, because we saw crude oil price went up a bit, so would that means that the reason for the Fed to increase interest rate in January? But because of that itself, right, that could be the last one. So the market is debating on this right now, and we are watching this very closely. But undeniable, we can see very clearly the 10-year yield now has dropped significantly. The 10-year yield now has dropped from the 5% mark, which I've been telling you guys to be very careful, because when it was a 5% mark itself, right, I was telling people that around me, say, be careful, something is wrong. It shouldn't pull back at 5%. It should go back to, it could go to 5.2, 5.5. But when it basically couldn't go past 5%, I know that something is wrong. I tell my friends around me to basically take a short position on the bond market. And truth be told, the market came down and it hit the first feeble number at 4.6 level. And you can see that it hangs there for quite a few days. Then when the next slide comes in, we know that it's quite clear it will reach the 4.3 level. But what is scary right now, it has breached past 4.3 and is heading for the 4.1. So when it comes to here itself, right, you can see the RSI will also be near the bottom. That is where we do expect a little bit of bounce over the area. But the question is this is not a technical thingy, because the bond market itself is a very like a temperature thermometer of the US economy. And if the yields is coming down like this itself, right, the bonds are actually going to go up, right? So if that's the case, why? Then, of course, when the bond price goes up, usually the equity market will take some profit. This is something we all know. So you look at the bond market right now. Now, a couple of days ago, I was kind of worried because we saw the bond prices going up, but the volume was coming down. But interestingly, last 2 days, the bond prices continue goes higher, right? But the bond volume goes up. So this is a real sales sign that the market is bullish on the bond market. So that means that, right, the inversion, the yield curve itself is shifting. And if they're shifting itself, right, the next thing will shift will be the credit default swaps, which is credit spreads. So when all these are shifting to the other side of town, that means that, right, the equity market may actually see some profit taking. So with that, that basically comes in line at why now the Wall Street is telling people that it's time to buy and buy and buy, and they get a super high level, while Bill Ackman is telling you that's risk here itself, and the bond market is showing something like that. So if all these things tells me, I kind of pretty confident that we may see a bit of profit taking in the next 2 weeks, all right? So this is where, but we must remember this, Bill Ackman covered his shorts right at the low at the market itself. So that actually gives you a lot of validation of this guy's call. And of course, right now, right, you can see the falling bond yield has made the rate hike very possible next month, which is the month of January instead. But after that itself, they expect the bond yield to the cuts to come in again. So all this tells you that there could be a real final interest rate hike, just to basically wrap up the Federal Reserve credential. All right, just to wrap it up. And then after that, they'll move into the brand new year and start to do what they need to do, is to bring interest rate down. Because if they don't do that in time, the high interest rate will cause a lot of costs on the yield side, and the interest to be paid is high, and the mortgages will go through the roof and stuff like that. So all these things itself, right, has to balance it properly. So that's the reason why I feel that, right, there's a good chance that there will be a rate hike first, one more time, and then that's it. There will be a cut coming in later on. And this is something in line with what Bill Ackman is saying. And of course, again, we need to watch the inflation very, very closely. And then the agency like S&P Global is actually looking at 4.6 for 2024, and they're looking at 2.9% for 2025. Wow, that's a lot. So are they going to expect the market to be really going to the sky? Well, it is possible. So the question is right now, the US dollar has came out quite a fair bit, right? That's the reason why propel the gold to go higher. So you can see that right now, right, it was at 107.19 back then in this November. I was telling my friends again, get out of dollar because they're going to come down. Now, back then, so there's a lot of quiver between why the dollar is a sell. It's not because the US economy is bad, but because at the Federal Reserve, once a moment, they kind of like telling people that it's going to be a rate high, but it doesn't fulfill. And then people knows that it's not possible to have a rate high anymore. And then people expect that the yield, the bond market recover. That's the reason why when the dollars have to fall, right, you can see that the yield actually went inverse, and that causes gold prices to go all the way across the dollar and the gold, they are in the way inverse relationship. So you look at it right now, the technical side here as well, right? This is a big movement down. You can see that. So you can take one, two, three areas. So by right itself, right, they should stop somewhere around here. So which means that 102.50, this should be the base of the US dollar slide. I repeat, this could be the base of the US dollar slide. So I expect a little bit of intermittent rebound on the US dollar very, very soon, because based on technical, 102.50 is the base level, and based on fundamental and what I expect to see, I do expect the dollar to recover. So if the dollar recover, then what will happen to the gold market? Well, there will be profit taking. So that's the reason why this morning we informed our students to get out the gold market. We saw at 12049, and we are happy with that positioning. And as a matter of fact, we are now looking at the US equity market. Now, based on the seasonal pattern of the weekly S&P performance of the last 28 rolling days, all right, we do expect to see some form of profit taking in the first what they call the first 2 weeks of the S&P. Then by about mid-month of the S&P, we do expect to see a strong rally, which is in line with the usual aspect of the Christmas season and also the New Year itself. So we can actually see towards that. And of course, based on the Russell seasonal pattern since 1979 until now, again, it's the same thing again. We do see a bit of profit taking for the first 2 weeks of the market. Then the market will base out in about the mid of December, and then the rally. So again and again, all these speaks correctly, because every time when everybody is so bullish on the market itself, you need to be very careful. Similarly, when everybody is bearish on the market, you need to be very careful. So that's the reason why you have MAO right here telling you and making sure that you check and balance. And of course, it's a very interesting chart. It's called a high yield CDS spread, which is the credit default swap spreads. So you can see that every time when the credit default swaps come down to this particular level, 404, you can see that the S&P 500 will take some profit. So again, it seems that we are near to the same point. So which means that, right, if we are looking at now, the dollar is to recover and the bond price to go up itself, right, all this possibility to see the S&P coming down a little bit. So again, all these speaks volume, and why I think that the next 2 weeks or so, right, we can see a bit of slow downside in the market. Let me know in the comment box if you disagree with me or you agree with me. Let me know, and I'll come back to you. All right. Most importantly, technical as well, right? We can see that the technical shows the ABC diagram, whereby you can see the market. Okay, the market itself. You can see that this is point A, this is point B, and this point C. We can see that the market is trying its best to go past the technical, but the RSI calling for the sell is definitely there. So I just feel that, right, the market may have to pull back down to 34,500 just to make things a little bit, easier to be digested by people. And then again, the market may test again. Now, of course, if the market really has the tenacity to go high, we can even see 36,000. But if the market doesn't really follow through, then we may see the downside to somewhere around here, which we'll cover in next other video. All right. So again, traders, this is the conventional. And to wrap it up, right, let's look at the TWB system. Now, the TWB system is very clear. We have a very clear color change. Red to yellow is a buy. So there was a buy call, and then the boys came in together with the sentiment. So we have a very strong buy call in the market. Okay. Then of course the moving averages both are bullish. That's clear. But today is very special. Today, the 29th of November 2023, we have the KSI now, which is a big boys indicator, is calling for sell. There are boys selling in the market. So of course the price is still going up. You can see there's no pulling back. So I will tell you this, the upside itself can go all the way to 35,828 in this week. All right. But if the market failed to go higher and there's a need to pull back down, then I suspect that the market may come down to the moving average of 34,694 in the near term. Okay. So I'm not saying that it will go which direction in particular, but based on the seasonal pattern and the way it's moving right now, with the bond, with the dollar recovering and stuff like that, I just feel that the market is going to do some form of profit taking. So let me know in the comment box if you have different opinion or you share the same opinion. I'd love to hear from you. This is Cal signing off. Like, subscribe, and share my video. Bye-bye.